Welcome to the Fund Your Retirement podcast.
How then does your portfolio of stocks, how would that fare in, say, a crash environment? Because as we do know that that's one of the fears for investors, especially investors that may or may not be considering to do it on their own. So how would your portfolio of dividend-paying stocks fare in that type of environment?
That's an excellent question. For the most part, dividend-paying stocks have a lower risk level than growth stocks. That's number one. Number two, if a stock has been paying dividends for a long time, and I'm going to say at least 10 years, and there are 31 stocks, we talked about this before, that have been paying stocks for 50 years.
Yeah.
There are over 120 stocks that have been paying dividends for over 25 years. And it just goes on from there. So when the market tanks, the tendency of dividends, regardless of what the market does, is to drop about 10%. So if you have a stock that's paying you 5.5%, you just wound up with a stock that's paying you 4.95%.
Yeah, understood. Yeah. So they'll drop the dividends type.
So they sometimes will tighten up the dividend. But remember, in order to change a dividend, the company's board of directors has to meet and change it. It's not just some guy sitting there at the office and say, hey, we're a little short on cash this week.
Let's lower the dividend. Yeah.
It's not that way. Okay. Dividend producing companies are more in line with the people who own them than growth companies are.
Hello, everyone, and welcome back to the Fund Your Retirement podcast. I'm Lee Cleesby, the co-founder of Fund Your Retirement. Welcome you back to your weekly insights from our expert guests in finance, business, and wealth building strategies, helping you fund your retirement. We've got Chip Stites back with us today to share his knowledge and key insights on dividend investing. This is how Chip funds his retirement, and Chip shares how his investment philosophy has changed over his 40-year investing career to where he is today, retired and living in Italy. Chip is a retired financial advisor and shares his 6-step process of how he selects dividend-paying stocks for his retirement portfolio. Hello, Chip. It's great to have you back on the show.
Lee, it's good to be back. Thanks.
Yeah. How's the weather there in Italy at the moment?
You know, we've just finished 2 or 3 days of rain and cold and slush. And right now it's in the 50s. It's nice, and all that's gone. So we've got sunny blue skies. Beautiful,
beautiful, excellent. Well, of course, mentioning Italy, part one was all about reframing what retirement meant, and part of that for you was to move to Italy, not just to lower the cost of your living, but also it was one of your major goals to succeed in a happy retirement. Part two, I wanted to focus on the finances, if that's okay with you.
I'd love to.
Yeah, so I wanted to split up into 3 topics for the audience. Part one, how you build your wealth and what you're invested in leading up to retirement. And then the actual transition from working, going into retirement, and then how your finances and investments look now in retirement, what you invested in, and how you're supporting your lifestyle in Italy. Does that sound okay with you?
Works for me.
Perfect. So first of all, how did your investments look building your nest egg leading up to retirement?
You know, Lee, over the 40 years that I was in the industry, my investments changed from one period to another period to another period. And so when I say that my investments changed, obviously when I started out, they were mutual funds. I mean, we're talking 40 years ago. We're talking about almost before internet.
Yeah.
I was taught to sell mutual funds, but then I realized I started digging into how mutual funds worked and what they did and what their managers did to them and how they were taxed. And along in the 90s came the first ETF, or exchange traded fund, which was SPY. It's the S&P 500.
Yep.
And I started looking at that and how it worked and how much cheaper it was and how much simpler it was. And then other things came along. So I got rid of my mutual funds and I switched to ETFs.
Right.
Then I started looking at ETFs.
Yeah.
And you can punch a button and find the top 10 holdings of an ETF.
Yeah.
And then I realized what ETFs were doing to make money. And so then I started taking the top holdings in an ETF and said, well, supposing on the value side, I just held Altria Group or Palmolive or whatever, and I just took the dividends myself and I reinvested those dividends. Now, let's dovetail that with a investment that I saw because I was managing it, $1.57 million in 1996. And this guy, that was my first perpetual income engine, or PI, perpetual income engine.
Okay.
Okay.
Yeah.
This is a conductor on a train who created a $3.5 million portfolio from about 1950 to about 1988 when he died, and he split it with his two sons, and he gave the house and the land to his daughter. So he left a $4.5 million legacy to his kids.
And he was a conductor on a train, you said?
And he was a conductor on a train, never made more than $40,000. He had 4 rules, and I think we talked about them last time.
Yeah, we did mention towards the end of part 1. Yeah,
okay.
But please mention them again for those that haven't listened to part 1, please. Yeah.
The 4 rules were: 1, buy only a company you understand.
Yeah.
Number 2, always get paid for the risk you take. Number 3, only invest what you can afford to lose. And number 4, reinvest the dividends and don't take them.
Very good rules to follow.
And extremely simple.
Yeah, very simple. So from then, did you start to live by those rules from about the mid-90s onwards then?
No, it took me a while. Because,
is that just for it to sink in sort of thing, or?
Well, not only to sink in, but remember, there's always pressure from the outside to do what everybody does.
Yeah.
Okay?
And you were in the industry, weren't you? A financial advisor.
I was a financial advisor. I had 7 different licenses. I managed up to $700 million. I had oversight on $700 million. I managed 100 million plus myself. And so there was always the pressure from the outside to do it this way because that's the way we do it. About 2008, when I began, and my average client in 2008 lost about 11.9%, had their money back the next year.
Excellent.
I realized that I'd hit on something. And then I reflected back to 1996. And I said, wait a minute, that's the same thing this guy was doing.
Oh, and then the penny dropped.
And then the penny dropped.
Yeah.
And I began to say, okay, you've been doing this all wrong. I lowered what I was charging to about 0.5%.
All right.
And I changed how I was doing it and selling it. And this came about gradually over a period of 4 or 5 years.
Yeah, understood.
And about that time, I had a group of advisors who came to me and threatened to sue me. Now, they aren't going to sue me. I wasn't doing anything illegal, but they were angry with me because I was not charging. I was charging about 1/3 of what they were charging.
Right.
And I was using things that cost 0.
What were you doing? Investing directly into the companies then?
Investing directly into stocks, as opposed to buying an ETF or a mutual fund or a closed-end fund or all the things that financial advisors are told to do because stocks are too risky.
Yeah.
And you can't understand what a stock does.
Yeah.
You don't have the education. It's just not true. But think of it this way.
Dividend-paying stocks, is that fair?
Dividend-paying stocks. Think of it this way. If everybody switched out of financial instruments into dividend-paying stocks with a few growth stocks, et cetera, what happens to the financial services industry?
Well, yeah, it shrinks considerably.
It goes away. So all that money on Wall Street is at risk. And so the idea that you can't do it, that you can't understand it, that you need our help, and all the language that nobody understands along the way. And I've just finished creating a vocabulary, a very simple vocabulary of 40 or 50 words that if you understand it, you can do it.
Yeah.
And not only that, the future-proof your retirement formula is a formula for doing this in 4 to 6 steps with 4 to 6 different kinds of stocks. That's all.
Right.
Now,
future-proof formula. What's that? Where?
The future-proof formula is what I call my perpetual income engine.
Right.
Because you used a particular word when we were talking earlier, and you said, well, when people retire, they begin to draw down their investments.
Yeah.
The objective is never to draw down your investment.
Mm.
But as that conductor did,
live off the income.
He lived off the income, and he left it to his children. Some of them, they take a little bit of income, but it continues to grow, or at least it did when I separated from that company at that time. And so that portfolio continues to grow and continues to provide income. And so those children and their children's children and their children's children have a separate income.
Yeah. And in retirement, I guess that's still then generating income during the days when you weren't able to work anymore, or choose not to work, or choose to do something else in retirement, which is what you've done, which is exactly what you've done. Yeah.
Yes. And so I've dropped all my licenses. I don't have them. And I'm just teaching a process.
Yeah.
Just a simple 4 to 6 step process in 6 different areas. We have high dividend stocks. We have dividend growth stocks. We have real estate investment trusts.
Right.
Then we have preferred stocks for income and bonds. And then we have what I call offsets and growth stocks. That's it.
Yeah.
Very simple. And people who like doing this themselves or who want to get rid of their fees can do this. And so by 2011 or 2012, I had begun the process of changing this for myself and watching it and seeing how it worked, et cetera, et cetera. So I was doing this for my clients. I was doing it for myself along the way at the same time, because I had another rule. If you aren't willing to own it or do it yourself, you shouldn't do it to a client.
Yeah, that's a very good rule to have.
Simple rule.
Yeah.
Right?
Yeah.
And so if I couldn't understand it, I didn't own it. If it didn't pay me for the risk I took, I didn't want it.
Yeah. Yeah.
And so gradually over time, this has come from, I'll buy that stock, or this is paying a good dividend, to a process that allows the average person to understand and manage a simple portfolio.
Yeah. Would you mind sharing just a little bit of what that process is? Like a step? Okay. Yeah, that'd be fantastic. Right.
You know, we're told it's too difficult to find stocks, to pick good stocks.
Yeah. That is a bit of a common narrative I find as well, that people do think it's actually quite challenging to find a stock and to invest safely. So
I can't tell you how many times, that would scare me. That's scary. That's frightening. Because that's what they've been taught. That's what the advertisements tell them. But let's look at this. Let's do this first. Step number 1. You're going to pick 3 sectors, and all you're going to do is check a box. And they're all defensive sectors. So for this purposes, it's consumer staples, things like Kellogg or whatever, okay?
Yeah.
It's utilities that normally pay a good dividend, and it's healthcare.
Yeah.
Okay? So there's your first step. You're going to pick 3 sectors. Second step, you're going to go to dividend, and you want to yield higher than 5%.
Right.
So you're going to push yield, and then the higher than 5%, actually on Schwab, it's 4% or more. You're going to push that button.
Yep.
Step number 2. The third step is that you're going to look at your risk. Now, risk is something called beta. And beta is the amount of risk that stock takes against an index like the S&P 500. And you're going to ask for less than 60% of S&P 500 risk. So you're going to push the less than 60% button.
Brilliant.
Okay.
Yeah.
Now, the other thing you want is you want your stock to continue paying you for a long, long time. You don't want to worry about whether or not they're running out of money or paying too much or whatever. Okay. So there's something called a payout ratio. Now, this is the amount of earnings that a company pays out in dividends to its shareholders. You want that ratio to be less than 60%.
Right.
Because you want them room to grow a little bit, right?
Yeah.
You don't want them paying out all the money, and you especially don't want to see them paying out more than 100% because they can't keep it up.
Yeah. Yeah, it's true.
Okay. Step 1, step 2, step 3, step 4, push the results button. Now, when I do that at Schwab, I wind up with 6 or 8 stocks. That's all.
Yeah.
Now, which is first for me? The yield, the coverage, the risk, or the sector? If I choose one of those, 1, 2, 3, or 4, and I number them, now the stocks that I want come out in order 1, 2, 3, 4. Boom.
Brilliant.
It's not what we're taught.
Yeah. Yeah.
And they won't teach it. It's very hard to find basic investment classes, and that's what I'm trying to put together. That's what I am putting together. That's what I have, a basic investment class.
Brilliant.
It's just not hard to learn.
Can you imagine if this was just taught at school or high school?
If people would just teach in simple investing, there's a guy who's known for this. His name is Warren Buffett. And he has a company called Berkshire Hathaway.
Yeah.
Now, does he pay out his dividends? No. Because he wants them himself to make other deals. He's gotten rich on those dividends. And I always find it interesting that if a great big foundation, the Ford Foundation or the Mellon Foundation or the Gates Foundation or Warren Buffett, when they started, they didn't go out and buy the hot stock of the day. They didn't look for one with the most growth potential. They didn't go out and buy Tesla. Warren Buffett bought Coca-Cola. And they bought Palmolive. They bought the things which pay them to own it. Why? Because the foundation's going to pay money out to other people, and that's what makes them a foundation legally.
Yeah.
Well, why not start your own foundation for your own self?
It's a good way of framing it. Very good way of framing it. I like that.
That's what this is about. The biggest worry of retirees is running out of money, right?
I would say probably, yeah. And you've worked with a lot of retirees as well. So yeah, I would say.
Absolutely.
Yeah.
Well, the reason they worry about that is because they're taught to take out growth. They're taught if your stock rises, you take that out. Well, that's great until the 30% of the time that the market goes down. So if the market goes down 30% and you're taking out 5%, you just took out 35% of your dollars. And it's very difficult to recover from that over time. As a matter of fact, I've gone back and looked at the S&P 500 from 2000 to 2020. And if you take out growth, you wind up with around $178,000. If you take out dividends, you wind up with around $351,000.
Right.
Because that's one of the worst periods and the best periods.
Yeah.
So the deal is this. You don't want to take out any more. You don't, how do I phrase this? The most growth you want to take out of your portfolio is about 18%. You want 82% of what you withdraw, at least minimum, to be dividends.
Right. So just expand on that. When you say withdraw 18%, you mean take out as like a lump payment sort of thing?
No, I mean that every time a stock pays a dividend, it comes to you.
Right. So that's 18% of that to you, and then 82% remains reinvested back into.
No, I'm not being clear. My fault, Lee.
Yeah, no apologies. You might be for the audience. I do apologize.
you want 82% of what comes out to be the dividends of the stocks you own.
Right. Okay. And that's your income. 82% is your income then.
And that's your income.
Yeah.
The other 19% can be growth, but you don't want it to be. You prefer 100% to come out as dividends because most dividend stocks pay out a dividend of X and they grow a little bit Y.
Defensive stocks.
Defensive stocks, not just that, but I'll give you a biotech that does a very good job of paying out a decent dividend and growing. Its name is AbbVie.
Right.
And so it's not just defensive stocks, it's just locating the stocks that do things the way you want them to.
Yeah, brilliant.
Now, I was not suggesting that anybody needs to own AbbVie.
No, absolutely
nor
not.
British Tobacco, nor whatever. Okay, I'm not telling you what to own.
No,
I'm talking about a process.
Yeah, we're just having a conversation. This is not advice or anything like that. This is just information, sharing information and knowledge. So, I'm sure that we're all very appreciative for as well. I mean, all that was absolutely fantastic. That you've basically shared how it kind of transpired way back in '96. And then you started implementing this strategy around 2011, 2012. And I'm presuming that what you've described there is how it looks now as well in retirement. You are
very much so. I mean, I always was. It just took me a while to figure out.
Yeah.
I always was a value style dividend investor. I always was.
Yeah.
The problem is that all the noise around me says you can't do that.
There's a lot of noise around things like that now as well, isn't there?
There's a tremendous amount of noise. I mean,
growth stocks are, they get a lot of attention, don't they? And I think that plays into the instant gratification that's built in with us.
That brings up a great topic, Lee. Thank you. You just handed me a softball. I love it.
You're welcome.
There's something called a PE ratio, which is the price earnings ratio of a stock, which is the price of the stock divided by the earnings per year of a share of stock from that company, right? Now, right now, Tesla's PE ratio is around 300, which means Tesla would have to earn money for 300 years to pay you back for what you purchased the stock for today.
That's insane, isn't it?
Now, I'm not going to live for 300 years. So I prefer a stock that will pay me back for what I paid for it within my life. That's the first thing. The second thing is, when I was coming up, when we started, the average holding time of a stock was between 5.5 and 7 years. And we talked about this last time. The average holding time today is 5.5 months.
Yeah.
Because we want a stock to grow.
And do you think the Fed, and we're probably going to deviate a little bit here, do you think the Fed has encouraged this type of environment with its liquidity printing?
Without question.
Because
without any discussion.
Yeah, I do as well. I mean, the Fed's had such an impact on the market and in the investor's mindset that it's massively distorted the market now.
It is. And not only that, there are, I think I was reading a statistic, there are over 7.5 million new investors in the last 2 years. Now, new investors, for the most part, and I go into chat rooms and I read every so often this, that, or the other things. New investors are buy this, buy that, get this. All right, I just sold, I made 20% and I just sold this. And now I'm doing this. And they're following one another.
Yeah.
That's called chasing returns. One of the biggest mistakes an investor can make, because sooner or later, Mr. Market's going to chomp you.
Yeah. One of the biggest chat rooms is Reddit, isn't it? With, I think, 5 million subscribers that I think encompasses what you're getting at there. Yeah.
That's how you get GameStop. That's how you get all those things that happen.
Yeah.
And it's just, I've been I've been talking to investors for 40 years.
Hmm.
And when things are going well, we're all geniuses. Every last one of us is just hitting home run after home run, and it's great. Oh yeah, this is simple. I'm doing this, I'm doing that. And that's what happens 70% of the time. We forget about Warren Buffett's rule number one. Don't lose money.
Don't lose money, yeah. And rule number two.
Number one wasn't make money 70% of the time.
Yeah. What's his rule number two? Don't forget
about rule number one.
Yeah. Yeah. Yeah.
And so why is it that this guy who's done so well bought something so simple, Coca-Cola? That's how he started.
Hmm.
And he keeps the dividends so that they work for him.
Hmm.
And he holds them forever.
So we've kind of covered there a little bit about the Fed and potentially the risk of growth stocks and the risk of the market. How then does your portfolio of stocks, how would that fare in, say, a crash environment? Because as we do know that that's one of the fears for investors, especially investors that may or may not be considering to do it on their own. So how would your portfolio of dividend-paying stocks fare in that type of environment?
That's an excellent question. For the most part, dividend-paying stocks have a lower risk level than growth stocks. That's number one. Number two, if a stock has been paying dividends for a long time, and I'm going to say at least 10 years, and there are 31 stocks, we talked about this before, that have been paying stocks for 50 years.
Yeah.
There are over 120 stocks that have been paying dividends for over 25 years. And it just goes on from there. So when the market tanks, the tendency of dividends, regardless of what the market does, is to drop about 10%. So if you have a stock that's paying you 5.5%, you just wound up with a stock that's paying you 4.95%.
Yeah, understood. Yeah. So they'll drop the dividends type.
So they sometimes will tighten up the dividend. But remember, in order to change a dividend, a company's board of directors has to meet and change it. It's not just some guy sitting there at the office and like, hey, we're a little short on cash this week.
Let's lower the dividend. Yeah.
It's not that way. Okay. Dividend producing companies are more in line with the people who own them than growth companies are.
And also as well, I just wanted to add in there as well, you mentioned defensive stocks. So these dividend paying stocks they're around consumer staples, utilities. These are things that during the good times and bad times people need.
They're in every sector. IBM pays a nice dividend.
Yeah.
And that's definitely not in the defensive sector.
Yeah. Oh, no, but what I mean is predominantly, because you are, I know you've mentioned there you've got, you do have other stocks in there, but is the core portfolio primarily of a defensive nature that people always use in good times and bad times, utilities, consumer staples?
Yes. Let me reframe that.
Sorry, I was trying to get to the reframe.
No, that's an excellent question.
Yeah.
Let me reframe that. The object of the portfolio is to keep overall risk at 70% or less than the S&P 500. Now, real estate investment trusts can be 75% or less or 70% or less, but most of them are more. Even the good dividend paying ones, real estate is more economically sensitive than something like Coca-Cola.
Yeah.
So between high dividend stocks, dividend growth stocks, real estate investment trusts, preferred stocks and bonds, and what I call offsets, which are things that go up when the market goes down, and that's commodities, mining, the things that people run to when they see the market dropping.
Yeah.
And growth stocks, which represent about 10% of the portfolio. We try to keep the portfolio overall at about 70% or less risk than the S&P 500.
Okay. Yeah.
And that depends on, I own stocks that are not defensive at all.
Yeah.
But that pay a good dividend. I own an insurance company that pays a very nice dividend that has very little risk to it. So it's in finance, not in the defensive stocks.
Understood. So you do have a bit more of a broader range then. I mean, that's, yeah.
Absolutely. Diversity, like anything else, like we're always told.
Diversification.
That's why you buy a mutual fund, right?
Yeah.
Diversity is an issue, and it's a way to earn safety.
Understood. So first of all, I mean, what you shared there has been brilliant. And I hope that the audience has got some huge insights, because there was so much really good information there. As we come to the end, are there any sort of, looking back in hindsight's a wonderful thing. Is there anything you think you would have done differently, or perhaps done things earlier?
Yeah. I should have started this in 1996 when I first saw it.
I thought you might say that. Yeah.
Yeah. The other thing
So
is
the messages get started now for anyone listening.
I don't care whether you're 24 or whether you're 64. I don't care.
Yeah.
The other thing I will say is that if you're within 5 years of retirement, you need to drop your risk. People don't talk about this. They say, oh, 5 years from now, the market's going to grow, et cetera, et cetera. Well, let me share a little bit of statistics and historical view. Anytime the stock market, the average price earnings ratio, PE ratio, has gone over 28, there's never been a positive decade after that time in history.
Right.
Now, could this be different? Absolutely.
We've just crossed 28.
No, we're at 30, 35 or 36 at the moment, or 33. I haven't looked at it the last couple of weeks, but we're nicely over 28. And I don't know whether you've noticed, but the market's been a little rocky the last few weeks.
Yep. Well, talk of interest rate rises, talking of the
Fed stopping its QE and all the stuff it's been doing to gas the markets to push the economy.
Yeah.
Yeah. It's kept its foot on the throttle too long, in my humble opinion.
We're at the early stages of the taper tantrum that we've experienced in the mid-2013s, perhaps.
As in all things market, you never know. Nobody knows what's going to happen tomorrow. But right now, I would choose safety and dividends over growth any day of the week at this period of time. So if you're within 5 years of retirement, if I were you, I'd take my foot off the gas and get careful. Yeah,
fantastic. And again, it's not advice. We're just sharing information, just having a conversation. Please don't take, please go and book yourself an appointment with a regulated advisor before making any decisions.
Yes.
We don't want anyone doing anything.
Thank you, Lee.
Silly. You're welcome. No, thank you. Chip, how can they find you? Where can you learn more about your future retirement?
In talking more about this, and I was an advisor. I will give you a process. I'm not going to advise anybody on what to buy. That's your deal.
Yeah.
I'm going to teach you how to fish. I'm not going to hand you fish.
Yeah.
So if you'd like to talk to me, send me an email at info at thelaughingretirement.com, all one word.
And I will make sure that that's in the show notes and your website and social media channels as well.
I appreciate that. We have The Laughing Retirement is my website. Info at The Laughing Retirement is my email. And we have a Facebook community called The Laughing Retirement Community.
Brilliant. Yeah. And I'll make sure, as I say, all those links will be in the show notes. Well, again, thank you very much for your time, Chip. Absolutely brilliant.
As always, it was a pleasure, and I hope we get to chat again, Lee.
Yeah, I do. We definitely will. Thank you. Thank you.
You're very welcome. You have a good day.
Bye.
I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and our website fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.